I think my board is working now, hopefully. All right, we're set. All right, for Chapter 8, our discussion on short-run decisions starts on page 393. And the company profile on this chapter is Navistar. And their short-run decision that they were trying to decide is whether to make their axles themselves or buy them from a supplier. And we're going to take a look at some of those decisions. And the big word in this chapter is the term relevant cost. So some costs are relevant in our decision and some costs are not relevant. So that's basically kind of a nutshell of what we'll be talking about. The chapter starts with an analysis on how our decisions made. These short-run decisions that we're looking at. There's a series on pages basically 394 to 395 to 396, an analysis of this decision process, and it's pretty much, it actually runs into 397, it's pretty much self-explanatory. I'm not too worried about it. I do have our first problem is to show the steps, and I think just going through that one problem will basically help us to get the steps in the right sequence. So starting off with step 1, we recognize and define the problem. Step 2, what are the possible alternatives? And then identify the cost and benefits of each alternative. We have to determine, here's that word again, what costs are relevant in our decision, and also assess not only the financial numbers, what does qualitative mean? Qualitative factors. Yeah, quality is one. There might be some government input into what we can and cannot do, who we can trade with, who we can't trade with. There is also a lot of environmental concerns now with many of the things we wish to do or can't do because of environmental reasons. So that's kind of wrapped in that step 5, and then hopefully with that in mind we make our best decision, which is step 6. So that's all discussed on these first couple pages of chapter 8. The problem I have here is our first one, and let's just quickly go through those. It's problem 36, or exercise 36. And all I need to do is just list these in order, these decision-making steps. Pretty straightforward. So if I go to page 437, exercise 6. What order do I put these in? So I would think the first one would be
recognize and define problem.
Yeah, identify alternatives. Oh, excuse me. Recognize and define the problem. Number 4 is first. Correct. Ashri, you're exactly right. What's next?
Identify alternative as possible.
Yeah, I think number 5 is second.
identify cost and benefit associated with it.
Yeah, I would agree. Step 2 is the third sequence.
Total relevant cost and benefit for each alternative.
Yep. Step 6 is the next one. We're getting down to the last two. We got to assess what those non-financial numbers, right? Qualitative, which is step 3. And then finally, with that in mind, with our cost information, we pick number 1, right? Which is the best for our company. So those are the sequences, that are the steps that we should use whenever we're making a decision. So the decisions that we're going to approach tonight begin then on page 398. But we have to get into some terminology first. On page 398, please know this definition. What is a relevant cost? It has to contain 2 requirements. The cost must be a future cost, and the cost must also differ among or between the alternatives. A future related cost, and it must differ across alternatives to be relevant. So we'll talk about that tonight as we go through our examples as to which ones are relevant. And if it's not relevant, the other choice is irrelevant or not relevant, right? So that's the alternative to relevant. So another term that we need to know is opportunity cost. We don't talk about this too much in accounting, but you do in economics. Oh, excuse me, 399.
Yeah.
Opportunity cost is lost revenue. Lost revenue. This is relevant. This is a relevant cost. Lost revenue, because if I make a choice, I may lose the revenue from the other choice, right? So that is a difference between the two, but again, we don't really track it in most cases because it's not known. It's an unknown, basically, in many cases for accounting purposes. But just kind of know the definition. By coming to school, you lose your wage revenue. That's an opportunity cost. As another example. I'm just going to pass this. Sunk cost is another term I'd like you to know. How is this defined? This is on page 400 now. A sunk cost is an irrelevant cost. Irrelevant cost. Because it's not changed by future action. An example of a sunk cost is depreciation. Again, know what depreciation is. It's a cost that we're expensing for a purchase we made 5, 10, 20 years ago. So that decision cannot be changed going forward. It's already been made and it's already been sunk. And they do some great examples here about sunk cost. So if you get a chance on page 400, I know a lot of times we don't read the chapters, but they do talk about Coca-Cola And you guys are probably, well, most of you, they came out with new Coke back in the 80s, and it failed, and they had to go back to the original recipe because there were so many complaints. And it's the psychology of trying to keep going when it's not working. And that's what some of that psychology influences our decisions. So you have to be careful. Also, Toshiba is another example here. And they were trying to come up with a high definition DVD versus Blu-ray from Sony. And obviously the market said that we're going to use the Blu-ray. But Toshiba kept sticking money into this operation when they know they were not going to win. So again, that sunk cost mentality was influencing their decisions. So some interesting real life examples there. So, some assumptions, we do have to make some assumptions, and one of them is on cost behavior. We have two behavior types. There's a variable cost and a fixed cost. And the assumption is, in all cases, fixed costs are irrelevant. And in all cases, this is the assumption, variable costs are relevant. Now that is true in most cases, but not all. So don't make that assumption. And we'll cover that in some cases where a fixed cost could be relevant instead of irrelevant. So this is on page 401. Again, we got to make some assumptions, but they're not always correct in all cases. So what are the decisions, or the short runs decisions we're going to cover tonight? Here they are. We're going to start with make or buy, keep or drop, special order, and then joint processing. There are others, but these are the ones that we're going to cover in Chapter 8. So let's start with make or buy. This begins on page 403. This was huge in the 90s. We were losing our shirts in the market. So many companies, instead of making it here in America, we went to where? What was the big place to go? Either China or Mexico, right? In fact, there's still a predominant push to move things over there because of their ability to make the product cheaper there than we could do it here. That is changing in some cases, but still has some merit. So it talks about Navistar and going through this make or buy process. Example 1 is our first example tonight, showing what costs again are relevant and what costs are irrelevant. And this example is on page 405. So we have a list here of what it costs to make something. In this case, $82,000. You notice that the cost items are listed here. These are our product costs. And we learned this in cost accounting, that we have materials, we have labor, and our overhead is based upon behavior types, both fixed and variable. But as we turn the page here, we'll notice that not all costs are relevant. And if we look at the solution here for problem 1, you'll notice that which ones are relevant. The variable costs are relevant. the variable costs are relevant. The fixed cost is mostly depreciation, and that cost would remain no matter whether we make it or buy it. That cost is associated with the cost that we purchased that item 5, 10, 20 years ago. So that's why it's not on our list. It doesn't make the definition. Is it future oriented? Our fixed costs are not in this case. Does it change between alternatives? Our fixed cost does not change between a make or a buy alternative. So we have to assume then that those are irrelevant costs. So looking at this, compared to our buy choice or alternative, we are cheaper to make it in-house rather than purchase it from an outside supplier. So that's kind of the reflection that we have to go through to make our decision, going through those steps again, those 6 steps. So let's try a make or buy question and see how this works. Example 38. Example 38 in our packet. And it's on page 438. Now I'll present it as a example, just like example 1. So Zion's looking to decide whether to buy their product from Bryce at this point. It's a K2 unit at a price of $25. So from K2 here, we can get this part for $25. Now we're going to compare that choice to our make choice, looking at all costs that are relevant. If we read the information for Zion after the information in the table, it says the fixed overhead is allocated expense. None of it would be eliminated if production of K2 were stopped. So in the note, and you'll have to look for this in every make or buy decision. You have to find out whether that fixed cost is relevant or not. In this case, it is irrelevant. Whether I make it or whether I buy it from an outside source, fixed cost would remain. Fixed costs would not be eliminated. So if the expense is not going to change whether I choose make or buy, it's irrelevant. So this is an irrelevant cost then. So what is relevant? Well, our materials to make the part is relevant. The labor cost is relevant.
Yes.
Because if I buy it, I wouldn't need it, right? I wouldn't need the labor. And the variable overhead also could be eliminated if we bought that particular item. So I'm looking at $24.75 versus 25. So what should this company's choice be then?
Cheaper.
Make it, right? Because it's a cheaper choice. So the best choice here, make it. Now I know the author would like us to also complete that differential. So let's just do it here once. So I'd have 12 to make it I have the 8 1/4. I have the 450. And then the -25. So if I made it, I would be saving 25 cents a unit, just like we could see comparison. That's how they do it in the example. I think just looking at this, for most of us, we really don't need that third column. To answer our questions then, what alternatives facing Zion with respect to this purchase or production? The alternatives to make it or buy it. Those are the two choices. It says list the relevant costs for each alternative. Well, we've already decided that. Direct materials is relevant, direct labor is relevant, and variable overhead. If they bought the part from Bryce, which is the outside supplier, how much will income increase or decrease? So if I bought it, I would actually be losing money, right? How much would I be losing? I'd be losing the 25 cents per unit, correct. So income would decrease if I purchase by 25 cents a unit. And obviously the decision then is to make the part instead of buy it. Now 39 is the next one I'd like to try here because the information changes. So it says refer to the same information. So the purchase cost is still $25. This is 39 now. But if you notice in the paragraph, it says assume that 75% of the fixed overhead would be eliminated if that component were no longer produced. So 75% of fixed cost would be eliminated. At that point now, that portion is relevant. So the portion that I'm going to put here now is the eliminated fixed cost, which is the 75%. That's now relevant. This is now relevant to our decision to make or buy. That's 75%. So again, the variables are still relevant. 12, 8 1/4. Variable overhead is how much? 450, right? So the question is, how much of the fixed overhead is relevant?
150.
$1.50, right? So that becomes part of our make cost. If we make it, we keep that $1.50. If we don't make it, it goes away, right? It disappears. So now instead of $24.75, I'm at 26 1/4. Versus 25. So by changing one thing, what should we do now?
Buy.
We should buy, right? This is cheaper. So the best choice is to buy it.
I have a question.
Good, Aaron.
For the make column, why wouldn't you just put $2 and then in the buy column put 50 cents?
You could do it that way. That would work too, if that makes more sense.
Would 7 gauge mark it wrong though?
Yeah, because they're looking for just
They
the
want to
cost
do it like
that's
that.
relevant.
Okay.
Yeah, they don't want us to separate the two. But your analysis would be right. It's redundant to have the 50 cents though in both columns. You know what I mean?
Yeah, that makes sense.
Because then it would be, it's irrelevant, it would be in both. Because it's in both.
Okay.
Good question. Is everybody comfortable with how or why this is now relevant? Because it's, can be changed, right, in the future? If we decide to buy instead of make it. That's what makes it relevant. Kayla, how you doing out there? Okay, sounds good. Way to hang in there. Good job. So, what are the questions for question or exercise 39? If Zion decides to purchase the component, by how much will income increase or decrease? If they purchase it now, what's income going to do?
Decrease. Oh, increase.
Increase, right? Income will increase if we buy it. Buy is the better choice. It's cheaper. And it's going to be, how much am I going to make? I'm going to make $1.25 times, I don't know how many units they were looking at. But that's how much income would change. Why is the 75% figure in effect now on this choice? It's a relevant cost. That changes between alternatives. And that's what's new with this exercise 39. And we already mentioned how much would increase or decrease. By how much would the per unit relevant fixed cost have to decrease before Zion would be indifferent to making or buying it? Well, that was the original 25 cents. So whatever that difference was. The main focus here, guys, is to just understand what costs are relevant and what costs are not. So that's the main focus here. Don't worry too much about this column. Okay. Let's look at 52 yet.
25 cents on the number 3.
Yeah, that was just,
25% or 25%. Oh,
yeah, it says per unit. And that was my original difference, Ashuri. That's why I chose that number.
oh.
Because that's all I needed to make it $25 between the two. So it was $24.75 versus $25 if I bought it. So that's where I got the 25 cents, that difference.
I thought we at the 39, I thought if we make it 26, 29, no?
Well,
Divide.
this is a different question.
Oh,
It says, how much would the per unit relevant fixed cost have to decrease before Zion would be indifferent? Oh, from the $1.25,
Yeah.
it would have to be $1. $25.
Mhm.
I was going back to the original. You're right.
So for this one, it would be 125.
It'd be
For the
125.
other one, it would be 25. and it was the
Yeah,
same
I don't know
question.
which problem they're
Okay, yeah, true.
looking at. Whatever makes it even, 25 and 25.
Mhm.
That's what we're looking for there.
Okay.
Seems redundant to ask the same question twice, kind of.
Yeah.
All right, for 52, again, we have to look at this chart for Part Q 108. Glassenham currently manufactures and produces 35,000 units of this part annually. The part is used in production of several products made by the company. Here are the costs, again, variable and fixed costs. We've got to look at, again, predominantly our fixed cost. So take a look at that paragraph. I'm going to start writing what is relevant. We're not sure of the fixed overhead yet. That's the question. And then purchase. And we can purchase it for how much?
Eleven.
11, right? $11. So back to our fixed overhead. What is the relevant amount?
and I have to use each one time by the unit.
Well, we have 77,000 direct fixed cost. Is this cost eliminated or not? What does it say?
If every minute they have to include.
So it says it would be eliminated if I bought the part?
If the total overhead aside Q.
Yeah.
They said they assign.
It says
Q.
neither of it, it says neither of it will be needed if it is dropped, right?
Yeah.
So that is, this is relevant then. Good.
Alright.
So that's part of our decision, correct?
I guess I'm thinking backwards.
I still confused. When we talking about relevant, that means it will be gone if we don't produce.
Correct.
That means we have to include, right?
Then we include it in our decision.
Okay.
Mhm.
But I don't want 77,000 here. What do I want here? The unit cost. How do I get the unit cost?
They give to you, right? 35,000 unit produced.
But that 350 has all relevant and irrelevant costs in it. I can't use 350.
Then you use
How do I do it? Aaron?
I took the fixed cost times the amount of parts made, and then subtracted out the 77,000. About the maths for all that?
Take 77,000 and divide it by
Yeah.
35,000 parts.
Yeah, that's what I want.
Yeah, so you added 2 cents for me. If it does the first time.
What is this, Jill?
The number of parts,
35,000, wasn't it?
yeah,
What's this division? 2?
2.2.
2.2 per unit. So of the 350, right, there was 350 total, 220 is relevant. So this is the main computation that you have to do on these type of problems. Let's figure out which ones are relevant. It's the cost that can be eliminated that then becomes relevant to our decision because it's different, right? If I make it, it stays. If I don't make it, it's gone. That's what's relevant. So now I add up the 8, 950, 1170, right, for my total here. Versus 11. What should I do? Should I go to China? I would, right? I would certainly buy versus make. What do we have to worry about though before we go to China? Tariffs and transportation is huge, delivery is a problem, and
Training.
not training,
Oh.
quality, right?
Oh.
Once in a while you hear lead-based paint and metal products and stuff like that, so you have to worry. This might be on the surface a good choice to go to the purchase route, but some companies found out that it was not a good choice, right? Because of the quality, the delivery, and so forth. So that's step 5. Remember, we got to worry about our qualitative factors before we make that decision. It's kind of cute. What would be the maximum price you would pay? $11.70, right? Because that's the max make cost. How much money is increased or decreased by purchasing it? We're saving how much money, guys?
70 cents.
70 cents, right? And we've got how many units? It was 35,000. Melissa, do you have that dollar amount? Must be like 22,000 something.
24,500.
That sounds better. It was kind of off. 24.5?
Yep.
It's close for you guys. How much were you off? 2,000? On tax, I'm talking.
Oh, $24.
Oh, that's minor. Okay. I don't know if there's another one of these. Do I have one more? 53. Oh, yeah, let's talk about, here's another term that they throw at us. 53. It says all the fixed cost is common. So a new term here, common cost, common fixed. in all cases, if you see the word common, it's a corporate expense. In some of your problems, they'll throw that word in. Therefore, it's a irrelevant cost. This is an irrelevant cost in our decision. So that means then that the only relevant ones are direct materials, direct labor, and variable overhead. None of the fixed cost is relevant. And then we have our purchase price, of course. So 6 to $1.50. Which now is $9.50 versus our 11 purchase. So whether I make it or whether I purchase it, the fixed cost remains, right? The fixed cost does not change. So that makes it irrelevant. So what would be the max price to pay in this case would be the $9.50. There'd be no reason to pay any more than that. And if they buy the part, they still decided to buy it, obviously they would decrease their income by $1.50 a unit times 35,000 units. $52,500. Is what they would lose if they decided to purchase it. Not sure why they would do that, but again, just the way the question's worded.
You said what maximum price you would pay an outside? I thought you did that if you want to buy, right? Pay for outside.
Yeah, because I certainly wouldn't want to pay more than what I'm making it for,
Or you want to pay?
right? So the max price I would pay is $9.50.
Oh, okay. Because it's cheaper.
Yes, it's cheaper now in this scenario. All right? Our next short run decision, even easier than our make or buy. It's special order. Special order starts on page 406. Easier than the make or buy. Special order basically says, hey, we've got excess capacity. What does that mean? If I have an operation that has excess capacity,
Yeah.
can I make more?
No, if you excess,
If I have excess capacity,
oh yeah, you can make more.
I make more units, right? I have time to make more units. I have the ability to use up more machine time and make more money possibly. So that's what this is about, is when I have that excess capacity, should I take on a special order? So the example here is example 2, and they're looking at basically, again, what costs are relevant and what costs are not. We are looking again at our overhead and specifically our fixed overhead as to whether it's relevant or not. And then we're looking at the two alternatives. Can we make it cheaper than what we can sell it for? So here is our example. We can sell it for $9 and it costs us $5.80, $6.80, $7.30. So we make $1.70 if we do produce it. or even though it's much cheaper. So our income would increase in this case because there's 20,000 units, $34,000. So let's just try one of these. Exercise 40, and then we'll take our break here. Smooth Company manufactures paperweights. I think they still make paperweights. And has been approached by a new customer with an offer to purchase 15,000 units at a price of $7. Question 1 is, what is the alternative? Accept special order, 15,000 units at $7 per unit. The alternative is reject order. So those are our two choices here. Accept the special order at a $7 price versus reject it out because of the cost. The new customer is removed from the other customers. They will not affect existing sales. They normally produce 82,000 units. That's my capacity number. But we're currently at 65,000. So the difference is how many units? 17, right? 17 is our excess capacity. So do we have enough machine time to make the 15? And the answer is, yeah. I have 17,000 excess. Why not do it? So it looks good on the surface, but let's look at our relevant cost. The normal price is 12, but the cost is $310 for materials. $225 for labor.
115.
And $115. Now, the question here, like with our make or buy, is the treatment of fixed overhead. Is Smooth accepts the order. No fixed manufacturing activities will be affected because there is sufficient excess capacity. So in the notes, fixed overhead won't change between choices, right? So with this information, we now have this as an irrelevant cost. So whether I do the order, accept the order, or whether I reject the order, my fixed costs do not change. So that's why it's not on the list as a relevant cost. What is my total relevant cost here then?
6.5. 650.
So if I can make it for $650 and sell it for $7, should I do the order?
Accept.
Accept it, right? I make 50 cents on every unit. So they just want us to do the math here. 7 is the selling price. 650 is the relevant cost. I can make 50 cents on 15,000 units, which is a whopping $7,500 more in profit, right? And obviously, if I'm making profit, I certainly would accept the order as my answer. Almost laid out very similar to what we did with the make or buy decision process. There are a few questions here to wrap it up. It says, briefly explain the significance of the statement in the exercise that existing sales will not be affected by the special sale.
Because it not decrease the regular sale.
Well, we normally sell them for 12 and we're giving this guy a break at 7. What if your existing client base would find that out? Would they be happy with you? No. Oh my gosh. So this is very risky to do this, to give such a low selling price. You know, they're paperweights, but still to give that low of a price is very risky if that got out, that information got out. And also, yeah, I guess that was the main thing there, that we have to be careful with that kind of behavior. Nobody likes to be thought of getting ripped off. So if anybody found out, that would be the bad scenario. Because everybody would be wanting it for 7 then, right? So that is a risk. Good. Let's stop here and take our break and continue on our quest.
This much is allocated. Not precise.
For problem 41, we're still looking at this paperweight special order. The selling price is still at $7, and we're still looking at 15,000 units. Now this analysis is a little cumbersome in that they're multiplying every one of these numbers by 15,000. And that's kind of redundant. I would like to just get our net here, so to speak, and then multiply 1 time the 15 rather than doing it 4 times. So let's look at our cost. The materials was at $310, but in the notes they're saying what they want to do is add a label to this paperweight, this special order. An additional 20 cents for a logo is added to the paperweight. So now my cost jumps up to $3.30 from the $3.10. The labor cost remains the same at $2.25, and so does the variable overhead remains at $1.15. So once I do this, I take my selling price and I subtract each of these costs. Do I still have a profit yet? How much? Did you have it, anybody? $0.30. So let's take that 30 cents now and multiply it by 15,000. And I get 4,500. Is my math right? 15,4, right? 30, 4,500.
45, yeah.
So I'm making 30 cents. I then, on 15,000 units, make 4,500. But in order to get that order, what do we have to do? We had to spend money on a what?
The logo label, we have to purchase special order.
Yeah, a
Housing.
machine purchase. Oh, there goes my profit, right?
Yeah.
So at this point, then, we would reject the special order.
Where did you get the 30 cents?
I just took the 7
Total
minus
subtract.
these costs.
You can total 3 of these and subtract 7 that we
Oh,
sell
I
for
see.
the
600. Okay.
Right?
Yep.
So I'm making 30 cents on every load, on every paperweight. But because of the profit, I'm losing 7,500. That's not a good decision. So it's not worth it. So we would reject the order in this scenario. So you can see how one little thing can change our answer, right?
Yeah.
We were accepting it, now we're going to reject it. But what could you say to the company? We'll do it, pay more, or pay for the machine, right? Reimburse me for the $12,000, then we'll do it. Or you could say, no way on 7, what should I be doing it for?
Gain the price.
What should I sell it for? You could go back to the 12, then we for sure might make it. But how much do I need to get? At least 7,500 more, which on 15,000 units is another 50 cents. So at 750, I'd break even. Anything over, I would make money. Does that make sense?
Break one.
I think I'm right on that. 50 cents, 7,500 on 15. That should do it. Something to think about, because that's going to be the next thing. Well, what should you sell it for, right? What should you sell it for? All right. Our next scenario, this is the fun one, is keep or drop. This is our project problem too, is a keep or drop a certain segment or product line. And this begins on page 408. So the example for this is example obviously 3. But one of the things that we address here in this part of the chapter is we're now going to do or look at a segmented income statement. And a segmented income statement basically is a divisional income statement. You'll have division 1, division 2, and then maybe a total at the end. And it's also organized as by behavior. So our variable costs are separated from our fixed cost. In addition, on our fixed cost, there are 2 types, direct as well as common. Okay? A direct fixed expense means it's easily traced to a segment. Also relevant sometimes. Again, the word sometimes. You can't always say it's always relevant because there are occasions where it may be irrelevant. Common fixed are corporate expenses. We talked about this earlier. They're usually allocated to a segment. These are irrelevant costs. So those costs, those common fixed costs, are not used in our decision process. They're irrelevant costs. So please know that difference. And they give some good examples of both direct and common on pages 409. So let's look at a direct. They're traceable, they're avoidable, right? In most cases, when the segment is eliminated. So they are relevant. So this means they're relevant in our decision. They're traceable, they're avoidable, right? And one example here was the sale, the rent expense of an office that we're going to consider dropping. So that is a fixed cost that is gone if we do eliminate that segment. So it's avoidable. The opposite of direct fixed is the common fixed. And the examples that they give here are corporate expenses, right? And these expenses persist. I like to use the word stay. So even if I drop the segment is dropped, those costs or expenses will stay. Therefore, these are irrelevant. So if we drop a segment, do you think we're going to touch the CEO's salary? No. That's going to stay the same. Example 3, we have MP3 players and smartphones, and there's a nice little income statement right here. This is a segmented income statement. You will have to create this in your project. There's a couple scenarios. But notice where the direct are located and where the common is located. The direct, right, are associated with the segment that we're looking at. The common is only in the total column. Those are our corporate expenses. So whether I drop the segment or keep the segment, that 120,000 is going nowhere. It stays, right? So these are irrelevant to our decision to keep or drop our segment. These here, in most cases, I'm not going to say all, are relevant. These would disappear if segment is dropped. Those direct would disappear if the segment is dropped. Another type of income statement is one where the common costs are allocated. This is on page 411. Can I just have you jump to that page 411? Looking at the left statement, which segment looks like they're in trouble? At the left side. Which segment? Gamma's in trouble, right? Gamma's losing money. However, look at gamma on the right side. Is Gamma really losing money? And the answer is not losing. They're what? They're making $12,000 for the company, right? So it would be an ill decision to drop Gamma, right? Because the company would be losing 12. What is that subtotal called? It's called segment margin. So a segment margin means the margin that the segment makes on its own. What are these costs here? These are allocated. And many divisions get in an argument as how fair is that allocation. In many cases, it's not fair. It's purely done by the level of sales volume. Well, that's not a good measurement to allocate 100,000 of expense to. So most companies, if you're not, to be fair, you wouldn't do that to a segment manager, right? You would be looking at this number. I'm not saying that this is a little low. It could be. So you may want to talk to that manager, but certainly they're still making money for you. Do you see the difference between the two statements? Here it's allocated, here it's not. This is a more realistic picture of how Gamma is doing. More fair, I should say. So, let's try some of these problems. Problem 4 is the example in the book. But I think for this, I would like to go right to a problem and then look at problem 4 anyway. I guess let's start here. I was thinking of not, but 43, page 440. Excuse me. Let's read the information for 43 first. It says Petoskey Company above, who has Allison, Boyne, and Conway as their segments. Assume that each of the 3 products has a different supervisor whose position would remain if the associated product were dropped. So what they're talking about is the salaries. Does everybody see the salaries? 95, 85, and 80. Who's in trouble here, supposedly?
Conway?
Conway's in trouble, right? So if we got rid of Conway, the salary for 80,000 would not be eliminated. It says here that position would be mean, whether they drop it or keep it. So, looking at the fixed cost, let's look at salaries. Is it direct or common?
Common because it's not going.
It's actually direct, right? The supervisor is working there. However, the problem is that salary stays, whether they drop the line or not. So then, even though it's kind of direct, it's common. It's irrelevant in our decision because the cost stays. Whether I drop that segment or keep it, it stays. The other fixed cost is depreciation. What is depreciation always?
The common is
Well, it's direct. but it's sunk. Again, cost stays irrelevant in our decision. Remember, that equipment was bought 5, 10, 20 years ago. That ship has sailed, right? We're just expensing it across future periods. So that is no difference between whether I drop or keep it. So now looking at those two factors, would they or should they drop Conway?
No.
They should keep Conway, right? What do they lose if they drop? They lose the what?
75.
The 75,000 margin. That's why we would not drop it, right? They would lose if they drop the $75,000 of margin. So let's look at 44 then, and then we'll talk a little bit more here. What changes in 44? Melissa?
The salaries is eliminated.
Yeah, salaries would be eliminated. So if that can be, if that cost is eliminated, then is it relevant or irrelevant in our decision? Relevant. How about depreciation?
Stay the same.
The same, right? Depreciation is sunk. That's the sunk cost. Irrelevant. So now at this point, we can look at the pluses and minuses. This is how I like to review these problems. If I drop Conway, what do I gain and what do I lose? So what do I gain if I drop Conway? What's my plus?
80,000.
The 80,000. Very good, Melissa. I gain that salaries that I don't have to pay anymore. But what do I lose? The 75,000. Lost margin. Contribution margin for this particular case. And are my pluses greater? Yep. So what should I do?
Keep or drop.
Drop, right? If I drop Conway, my pluses are greater than my minuses. So then my decision should be to drop Conway. So by changing one element of our decision here, where our salaries would be eliminated, it now becomes a good decision to drop Conway instead of keeping it. Should we try one more? I think we should. Let's try one more. Now, the complementary effect, and this is discussed on pages 413, the examples on 412. In many cases, when we drop a segment or product line, it affects other product lines that we have. So complementary effect means, hey, be careful, you're going to influence the decisions or the revenue stream of your other products. Because a lot of people or a lot of businesses buy from a certain supplier because they have multiple things, right? So by losing one, you might lose more. So example 5 is this complementary effect. And in my mind, it's very complex. So I'm hoping that this will simplify this analysis. So let's look at problem 45, please. 45. Now, I have on here, please use the information on 44, which was what? The salaries would be eliminated, right? In problem 44. So in that case, it is relevant. Obviously, depreciation remains at sunk cost. That is irrelevant. So whether I drop Conway or keep Conway, doesn't matter. Okay, so here's part of the complementary effect. It says in problem 45 that if we drop Conway, 20% of Allison's sales would drop. So sales revenue are going to go down for Allison, but also remember our variable expenses will go down 20%, right? So if we look at the margin number, what is the margin for Allison?
165.
And 20% of 165, because that's what's going down, right? That 20% is how much?
$33.
33,
Don't know.
right? That's a lot of revenue. A lot of margin being lost. So, here's where I do my pluses and minuses again. So if I drop Conway, Conway is dropped. Melissa told us on our last problem, my plus was 80,000. Ooh, that's freaky. Because I don't have to pay the salary. Salary not paid. Remember, that position would be eliminated. But what am I losing? What was the first loss? The contribution margin of Conway, right? CM of Conway. And now with the complementary effect, I'm also losing what?
Losing the Allison, the sale go down.
The contribution margin of Allison. So now I'd look at my pluses and my minuses, and it looks like I'm going to be at minus what?
Greater than plus
108?
28,000.
28,000?
Losing.
So if I drop Conway, I'm going to lose 28,000. So what should my decision be? Keep Conway, right? Pretty simple. So my decision keep Conway? Because I would lose 28,000. What the author has you do in problem 5 in the book is recompute the segmented income statement for Allison. Basically, add the other segment and then come up with a total new column and compare it to the old column. So that's a lot of work. In two steps, basically, I got the same answer rather than recreating those financials. So I'm hoping that this is a better choice, but if you prefer to do it the book method, that's fine. Either way. I think I have one more of these. Oh, I don't. Let me look. Here. Oh. Here. This is way back in your packet, I think. I don't think they're page numbered, right? Toward the end, it's probably one of the last couple of pages. One more left. There we go. Melissa's about it. Great. One more yet, one more page. Yes, that's the one. Kayla, do you have, or did you find this particular example? Okay, great. Thank you. We have two divisions here. Here's my question at the bottom. It says, determine the operating income for the company as a whole if Brothers division is dropped. We only have two divisions, right? So if I drop one of the two, I'm down to one. But what remains whether I drop Brothers or whether I keep it? What cost remains? This common cost stays, right? That's irrelevant. So how would you solve this problem? If I drop the brother division, what will my new income be? Zero. Yeah. I'll be at zero. Remember, the 2,000 stays whether I drop Conway or keep it. Or Brothers. How did I say Conway? So this then becomes 5,000, which then makes this 0. 0 is my answer. Make sense? How else could I have approached it? How much margin would I lose if I dropped Brothers?
Segment.
The segment margin, right? You could approach it that way as well. So if you're looking at dropping the division, what I want you to key on is find that segment margin, because that's what you're going to lose if you drop it. All right? Or if the segment margin were negative, if I dropped it, I'm going to increase my margin, my company income if I do so. That's what I want you to key in on those typical questions, whether to keep or drop. Now the next question is, should we drop brothers? And the answer is,
Zero, what's the, yes or no?
no, right? We don't want to drop brothers because we would lose $1,000 of income, right? My operating profit is now 0 compared to what it was 1,000 before, right? So it's a simple little question that students struggle with. And just kind of be watching for that on the test. If you turn your page backwards 1 page, oh, we haven't talked about this yet. Sorry. Sorry. Go forward. Kauai, Oahu, Hawaii. Does that kind of look similar? It's probably one of the last pages. Hannah Hang Loose manufactures surfboards. Okay, by hand, mind you, and sells them to tourists on 3 different islands. Which segment is doing poorly on the surface? Oahu, right? Oahu, right here. They're not doing so good. So that's what they're saying. They have a contribution margin of $200,000 right here. Sales minus the variable cost, which is a heck of a margin, by the way. That's awesome. I work on that number for sure, right? Get rid of some advertising. Anyway, all variable costs are relevant. Relevant fixed costs associated with this line include $250 in promotional effects. Well, that's given, good deal. To advertise the market. So, I'm going to put on here, this promotional is relevant. The depreciation is sunk, irrelevant in our decision. And this is always a good practice to look at. What are some of the things we could do to help that segment? Looking at the list here, what would you do? Which ones do I check?
Increase sale.
Increase, right? Next one, keep it or drop it. Would reducing sales help our situation? No, obviously not. All right, question 2 then. Which of the following are relevant benefits or cost if we keep or drop the market? Promotional is relevant, we already said that. What other ones? Sales is variable cost. We combine these two and call it what? Contribution margin, right? That's why I use the margin. Why take 2 numbers when I can use 1? Make sense? Okay? Now rather than do this keep drop thing, let's do pluses and minuses. So I'm going to go back to the page. If I drop, how do you spell O-A-U? What's a plus? How much, Aaron?
225,000.
Yeah, I don't have to pay that bloody advertising. So I'm gonna save that expense, 225. What do I lose? Well,
The contribution?
contribution margin, right?
Mhm.
Which is 200,000. Anything else? I don't think there is there? There's no complementary effect, right? I'm not gonna hurt any other sales margins or anything. So, guess what? If I drop Oahu, I'm gonna make 25,000 more. So what should we do? Drop it, right? What will my new income be if I drop Oahu?
24,000. You add 25 second margin.
We just said I would gain 25, right? So my new income is going to be 425. It's much better than that key drop scenario stuff. Does that make sense? Right? 25,000 if we drop Oahu, in favor of dropping Oahu. All right. The next item, oops. I gotta be careful here. I almost lost it. Or the last short run decision here is, I gotta get back to where I was. Joint costing, joint processing. And this is, or begins on page 414. This is our last short run decision for chapter 8. A couple terms again before we jump into this type of problem. There are joint products, split off point, and process further, or sell at split off point, basically. Joint product means that we have costs, the three again, product cost, material, labor, that are developing this product source, so to speak. So think of a gallon of gasoline or a barrel of oil. There's a cost associated with getting that barrel of oil. But at the split-off point, now the BP can decide, do I make gasoline out of it? Do I make diesel fuel out of it? Do I make kerosene out of it? Or heating oil out of it? That's kind of the analogy I'm trying to get to here. So all that cost to get that barrel of oil is the joint cost, And then after that is the individual additional cost to process it further. The example is 6, and they use apples, an apple orchard. And from the apples, they get grade A apples, B apples, or C apples. And they are looking at the B apples. They can sell it split off for $1.25 a bag, a 5-pound bag. Or they can make 500 cans of filling and sell it for 90 cents a can. Which is better? And the decision is it is better to process it further because they will make $330 versus the $150. So at split off point, I can sell the apples for $1.25 and make $150, or I can take the revenue at 90 cents a can, subtract the additional cost per can, and make $3.30. So would you rather make $150 or would you rather make $3.30? And the answer would be the $3.30. So this would be a decision to process further. Versus sell at split off point. Well, let's try it. 46 guys, and then we'll take a break, another break. I'm going to draw some lines here. What I'm doing is I'm taking this paragraph of information and then just trying to show a graphic picture of it. Hopefully this will help. So here we go. Bozo makes 2 products from a joint process. The joint process cost is $110,000. At split off point, they can make 2 products. They can make 6,000 pounds of LTE. And they can make 14,000 pounds of HF. At split off point. LTE can be sold at $55 a pound. HS can be sold for $9 a pound. They then have a buyer of HS has asked Bozo to process HS further into CS. That's my new line here. And they can produce 4,000 pounds. The selling price of that is $45 a pound. But it costs $34,000 to convert it. I think that's it. So that's what it's telling us in this example or problem. So the first question is, what is the contribution margin from selling the 14,000 pounds of HS at split off?
126.
It's actually here, right? 9 times 14,000. So for question 1, I would take the $9 times 14,000 pounds. That's 126,000.
Mhm.
And what is the margin if they process it further? So now I can make how much more?
4,000 at the 45
$45 times
4,000.
4,000 pounds, right?
Yeah.
Equals
180,000.
180.
Yeah.
But to get the 180, what did I have to do?
You have to subtract the cost that they have to pay for total process.
Yeah, the 34,000 cost, right? So what do I have left? 146. So I'm comparing the 126 to the 146. What should we do? Process further, right? So in this decision, should Bozo continue to sell at HS at split up or process further? We should process further. Because they'll make 20,000 more. And the joint process cost of 110 is a sunk cost. It's irrelevant in our decision. We never even used it in our decision to process further or not, so it's considered irrelevant. It's not unimportant, it's just not relevant in our decision to process further. All right, let's stop here, guys. I'd like you to go to the back of the packet again, where this example, this ABC Corp. has a joint process A and B products with a joint cost of $12,000. And what I want you to look at is this first question: which product should be sold at split off? Which product should be processed further? Now this is a test question that I developed myself because I didn't think the problems and exercises in the book prepared you very well. So this is not in the book anywhere. There's no example like it in the book. So I'm going to look at product A. Selling price at split off is $2. If I process it further, I'm going to increase my cost by $1. But if I get through that process, I can sell it now for $4. So what I want us to look at for our first question, to process further or not, is look at the center three numbers in both cases. So I'm going to add this to this information. I'm going to call this incremental revenue. What is the difference between 4 and 2? 2, right? $2 is my incremental revenue. My incremental cost is in the center here, is $1. So looking at that, if my incremental revenue is 2 versus my incremental cost is 1, should I process further?
Yes.
Yes, right? I make money. So product A would be better to process further. I make an extra $1. My incremental revenue, 2 minus the incremental cost is 1. I make an extra $1. Let's look at product B then. My incremental revenue is what? 50 cents. Everybody agree? 250 versus 2? What's my incremental cost? $1. Should I process further? No, right? Because if I do, I'm going to lose 50 cents on every one I do. So for question 1 then, product B, sold at split off point. For $2 each. We'll make more money if we go that route rather than process further and lose another 50 cents. It wouldn't make sense to do that. So one of your test questions next week will be to analyze the incremental revenue versus incremental cost and deciding whether it's beneficial to process further or not. Remember the joint, the 12,000 joint cost? Irrelevant in our decision to process further or not. Think of New Coke. New Coke, they were throwing more money because they've already had this huge investment in this product. Well, that should have not been even a relevant concern. You weren't making the sales, right, in the future. So that's what's happening here. And don't worry about the last one because we would not do this anyway. So cross that out. Your job next week is to decide how to make that decision to process further or not. That's what you need to know. Okay? Any question on this joint process further question? All right. Let's save what we got. Our last, semi-last topic is product mix. Begins on page 417. This is probably one of the more fun, for me anyway, I guess, fun computations. When we're looking at our product mix, think of a company. Amber works for a cheese factory that makes many different kinds of cheeses, right? So their dilemma is how much of each to make, right? You get this milk, what are we going to use with it? Or what are we going to do with it? So that's what this is about, is how much of each. And the author talks about the word constraint. Now, there are time constraints. Our machines are only so big, right? They can only make so much. So there's time on machinery. And the other constraint is, well, I can only sell so much of this pepper cheese versus another cheese, right? So there's a sales limit as to, in our decision process to make our best choice here. So exercise 7 and 8 actually have us decide how to determine the proper mix of these products. Now we're only going to look at 2 products at a time. To do more than 2, you almost need a software program to really do it well. So we'll talk about that term coming up shortly here. If you look at this, the example 7, X has a margin of $25 per unit. Y has a margin of 10. However, it takes 2 hours of time to make an X, and gear Y only takes a half an hour to make. So on the surface, it looks like I should be making all kinds of X's, right? But we'll find out shortly that that's not the case. What the author does is convert that per unit margin to what? An hourly margin. And if you look at X, my hourly margin is $12.50 versus Y's margin of 20. So which product should I be making first?
Why?
Y. I can make $20 an hour versus $12.50. So that's, if I have a time constraint, I'm going to be making all the Y's that I can. So that's what we find out here is then how much of Y should we make? Well, I have 40,000 hours available to me. If it takes me a half an hour to make one, I can get 80,000 units of Y made in that time constraint, assuming we have no sale constraint, right? And that I would make no X's. That would be the optimal mix. So on the test, when they ask for an optimal mix, if there is no sales constraint, I'm only making one of them, the one that gives me the most money. In this case, it's Y. And once I know that, another question, what is the margin I'm going to make at that optimal mix? How much dollars am I going to make, right? So they just take those 80,000 units times the 10 per unit. I'm going to make 800,000. So this is the example 7. Example 8, pretty much the same, except there's a sales constraint. I can only sell 60,000 units of X or Y. So again, I'm gonna do Ys first, up to 60, and then the rest of the time I'm gonna devote to making the X's. So that's example exercise 8. All right, so let's try this now with an actual problem. 47. We're going to make cars. Oh, I guess Reno is not a car. Tahoe is. 47 on page 441. For 47, there is no sale constraint. So of the two products, we're going to make one of all and none of the other. But to decide which one we're going to make, we got to figure out the margin per hour. The constraint here is time, and the constraint is 2,460 hours. Of paint time. That's our constraint. All right. So looking at Reno, how much does it make per unit? Yep, Reno. 120 per unit. And I'm going to divide this by, how many hours does it take to paint one? 5? Equals how much? 5 and 12 is 2. 24?
24.
So if I make a Reno, I'm making $24 an hour. Do the same thing with Tahoe. The product margin is
75.
75. How long does it take to paint?
3.
3 hours. That's 25. So which product should I make first? Tahoe, right? So the question is, what is my optimal production mix then? Well, there's no sale constraints, so I'm going to sell everything I make of Tahoes because that's all I'm going to make. So I have 2,460 hours available. I divide by 3 hours because 3 hours was the Tahoe. How many units is that? 820 units, 820 Tahoes. So the optimal mix is 820 Tahoes, 0 Renos. 820 Tahoes to 0 Renos. At this mix, what's my company margin then? Since I don't sell any Renos, I just have to look at the Tahoes. What did I make per Tahoe?
65.
Yeah.
Not dollar sign and everything.
Good. 820 units times $75 per unit. What is a common mistake here, though, that students make? Instead of 75, what do students?
They're going to use 25.
They will
instead.
use the 25. Why shouldn't I use the 25?
That's the per hour.
That's per hour, not per unit. So be very careful with this question. It's a simple multiplication, but guess what? There will be an answer assuming you use the 25 instead of the 75. So be very, very careful here. If I got units, I gotta be multiplying by margin per unit. So 820, 61.5. Very good. Is our answer for the contribution margin for the company as a whole. Okay, so let's review the steps. We've got a margin per hour. Once we know which has the larger one, that's the one we make first, and then use up the hours and find the margin for the company. Let's try with a constraint now, a sales constraint. Problem number 48. Problem 48. So we still have the constraint of 2,460 paint hours. But now we have a sales constraint of how many? 500. Two constraints. So we again do that same question one. What is the margin per paint? Reno, I don't want to redo the computation. Reno was 24 per hour. Tahoe was 25. That doesn't change. So which one am I going to make first? Tahoe's, right? But I can only sell 500 Tahoes. So how many hours do I burn up making Tahoes?
500 unit time by hour.
Times,
5 hour. 5 hour.
I thought it was 3.
Tahoe. Oh. Oh yeah.
Tahoes,
It's
it only
three,
takes
yeah.
3 hours to paint. 5 was the Reno. So I'm going to burn up 1,500 hours to make a Tahoe. I have 2,460 available, which leaves me what?
Subtract it,
960 hours left.
Yes.
So of the 960, how many Renos can I make?
You time by 5 hours.
I've got 960 available. It takes 5 hours to make. Leave me with how much?
192.
192. So my mix is 500 Tahoes, 192 Renos. That's my optimal mix. Right? Is everybody comfortable with the steps here? So at the last question is, based on this optimal mix of 500 and 192, we gotta multiply by the unit margins. So here we go. Tahoe was at 500 units. times 75, which is the margin per unit. The Reno's 192 unit times
120.
120 per unit. Let me just add those two together, right? Aaron, do you have the numbers?
37,500 and 23,040. That's 65.
Yep, 60,540 is the optimal product contribution margin with a sales constraint, basically, and a time constraint. Now, one more thing to throw at you. It revolves around these hours. That's per machine. You will encounter problems on the test or exercises where you're going to have 7 machines. Okay? So for your total hours, then obviously you got to take 7 times the hours per machine to get the total hours available for your hour constraint. So in this particular problem, I only had 1 machine, right? Be ready, though, for the problem that says there are 7 machines that can generate 1,000 or 2,000 hours in a year. So then I have 7,000 hours available to make my product instead of 2,000 or whatever the case may be.
They give you minutes instead of hours or something.
No, they won't give you minutes. It's usually based on hours per machine. All right. I need you to know this too. Multiple constrained resources. And the term is here. To generate an optimal mix. This is on page 420. Please note for the test. Linear programming. We only did really 2 constraints. Well, there's more than 2 in many companies. It's 4, 5, dozen, who knows, hundreds. In order to do an analysis of the optimal mix, you can't do it by hand. There's no way. So you have a program, a linear program, to do a best fit kind of thing, or best product mix for you with more than 1 constraint. I need you to know what that linear programming is. It's that software to give you that optimal mix with many constraints, not just a couple. To wrap up chapter 8 then, it's markup on cost. And I'll give you 65 as another example. I'll just give you that problem. We're not going to do it tonight. Problem 65, I'll just copy my day class. If you want to look at the notes and you want to practice this multiple constraint, problem 65 will be that example. But the last topic I wanted to address in Chapter 8, this is on page 421, 420. And I know you've done this in other classes. We've done it in cost. This is nothing new. Cost plus a markup to get a price, right? A markup. I mean, you've done it countless times. So the example is example 9, and they marked it up 20%. So you take your cost plus your markup, and that's your selling price. Pretty simple. How else can I get this answer? 82, 8. Multiply by what? 1.2. This is the way I do it. It's much quicker. 1 is the cost, right? 0.2 is the markup, if you want to look at it that way. That's a markup. And there's also a, and I'm not even going to go through the examples, a target costing. This is on page 422. Before a company will do a new product, they want to make sure they can make the money on it, right? So this is in the development stage, the R&D stage. Marketing will tell them, hey, we can make an iPhone and we can sell it for $2,000 a piece. Well, then the R&D department takes that information and says, well, let's take that selling price of $2,000, subtract the profit that we need, and we come up with a target cost. If we can hit the target cost, then we'll make it. If we can't hit the target cost, we won't, because we're not going to make money on it, right? Or enough money on it. So it's a simple subtraction, basically. They wanted 15% profit, so you just take that 15% off of the price. So our target cost in this case is 170. How can I get to that number quicker? Multiply by what? 0.85, right? So 1 minus 15% is 85%, right? Times our $200, our selling price, gives us a target cost of 170. So if I add up my direct materials, my direct labor, my overhead, and it exceeds the 170, I don't do it. If I can get below the 170, then I can make the product, and we will sell it for $200 a piece. So that's kind of how that works. Target costing, and then markup on cost. Again, pretty simple computations. I will give you those answers. You can just look at them and verify them. And you'll do some in your exercises also, obviously. Wow, gang, we did a lot tonight. I think I've covered everything that I wish to. other than those few, and I'm going to add those later. The rest of the night is yours. You can do so with what you wish. If you want to stay, I will stay. Next week, I would like you to try to make it if you can. It's our chapter 9, which is our largest chapter. It's also the chapter that you will be paired up with a group person to do an Excel project for the TSA CNOW assignment. The 25 point is now going to be 50 points because of the TSA requirement. So it's on budgeting. It's not hard, it's just time consuming. So kind of be ready for that. I think we are scheduled to do that in 2 weeks, not 1. Let me just check that though. Kayla, you're still with me, right? You're awesome. Thank you. So for chapter 9, which is next week, on April 2nd, right? So yes, we are taking 2 weeks for that chapter because of that extra requirement. Okay, good. Excellent, Kayla. Thank you. So yeah, try to make it. I have a couple big, large packets to hand out because they're budget reports. And I want the Excel project. It's not worth a lot of points. It's 7. But at this level, I'm expecting a lot from you guys. I want the Excel worksheets to look spectacular. So that's my goal here. I want, because they are a reflection of your work, right? As accountants, we're not well received in some cases. So when we can present our worksheets in a professional looking manner, that's what I would like from you in this particular project. So keep that in mind if you can. That would be awesome to come to next class period. I don't know, have I picked the groups yet? I don't think I have. Did I?
Yeah, there's a whole tab on Blackboard.
No.
So I did then. I get confused with what class and... So the groups are Julie and Fasheri. Tiffany, you're with Melissa. She's not here tonight. Joe and Aaron. Joe's over here usually. Jill, Sean, and Kayla, you're a group of 3. I might have to do some extra work with that group because you get 3 and not 2. Lucky you. And then Amber, you're with Linda. You've not seen Linda. She's on the internet, so you'll be communicating with her via internet. I've had Linda for probably, well, at least 2-3 years. I've never seen her. So, anyway, you'll have to communicate via email, basically. All right, so that's next week's agenda. Good, let's call it for tonight. The rest of the class is yours.